what ends up happening is either 50% or 85% of their Social Security benefit to now become taxable.
85%.
85% of their Social Security benefit would now be counted as taxable income.
So it's been said that the only certainties in life are death and taxes are complicated. What rate kicks in where, and on it goes. Plus the tax code itself is just daunting. Well, if taxes are on your mind today, then today's show, Taxes and Tentacles, is going to be very informative to you. It touches on one of our core pillars, and Michael's going to be here to talk more about that in just a moment. So grab your favorite beverage and get comfortable, and let's explore how faith-informed financial decisions can create the certainty you're looking for. So we're Bradford Hancock and Michael Wallin, and we're glad you're here today. Michael, how you doing?
Doing great, Bradford, and yourself?
Hanging in there.
You must have just done your tax returns. So
a little late.
As we start looking at taxes, there's that element is probably one of the most complicated elements that most of our clients ever experience. And it's because when people think about taxes, they think about those individuals that are doing their tax filing. And so if we put that in a perspective, there's two kinds of tax preparers out there. There are the historians. Those are the people that you typically meet in April and September of each year, and they write down what actually happened in the previous year. They're just historians. Okay. They're taking the documents that your custodians have sent to you. They're filling that information out. They are taking maybe some deductions that you have through your personal life, and they're putting that into that tax return to be submitted to either get a refund if you're on the good side of it, or to make sure that you have paid your rightful amount into the IRS. The other side of a tax preparer is that individual that really does tax coaching.
Okay.
And when we look at tax coaching, that's actually controlling your taxable event throughout the year.
So that's what it sounds like, a tax coach. You're coaching them through their taxes.
It is. It's actually having a plan in place. In our previous episode, we talked about IRAs and how generating taxable income that's coming to you in these years. How do you take that information and then how do you mitigate it? And a tax coach can help put a plan in place so that you don't get that tax tsunami that we talked about in our previous episode.
Tax tsunami sounds awful.
It's really hard to outswim it.
I can imagine.
Let's talk a little bit here about a progressive tax bracket, because a lot of people don't really understand how they're taxed.
Yeah. Explain that to them.
Okay. And we're looking at our 2025 tax brackets today. And I'll tell a little story to kind of explain this. I had a client in the office the other day that is still in their earning years. And their wife was sitting there with them, and they were in this discussion about some overtime that was going to be coming to them. And the client mentions, I don't want to do that overtime. That'll push us into a higher tax bracket, and we'll end up making less money this year. Well, that led us into a much deeper discussion around, well, let's first explore how are we taxed. So for our listeners here, under the 2025 tax code, the first $30,000 for those individuals that have earned income at that $30,000 range, if you're doing a standard deduction, that first $30,000 is tax-free.
No tax.
No tax. That's what the standard deduction is. So let's make this real simple. I give you a coupon worth $30,000. Now, that is the maximum amount. So if you made $20,000 of earned income this year, that standard deduction, that coupon is going to cover that first $20,000, no taxes. If you earned all the way up to $30,000, that coupon is going to be able to be redeemed and you're not going to have to pay taxes. That's what the standard deduction is. Under the current administration and under the previous time period as President Trump really wanted to increase up standard deduction for the common person.
Okay.
That was when we saw the first big bump. And now when I'm talking about these numbers, let's make this really clear. I am talking about married filing jointly rates. If you are a listener onto the show today and 30,000 just rung out in your head, I apologize. If you're single, you're going to have to cut that number in half.
Cut it in half.
You're going to cut it in half.
For the single. Okay.
For the single. So we're talking about married filing jointly numbers, but if you're single, just cut those numbers in half, and that's what will be applicable to you. The next bracket of our tax code is from $0 up to $23,850. So that would really be $30,001 is where that bracket starts. And that is our 10% tax bracket. So if you max out all the way to the top side of our 10% tax bracket, you would add your $30,000 of standard deduction, the tax-free money, along with the $23,850, which would give you a total amount of $53,850 for that married filing jointly couple that would max out the top of the 10% tax bracket. But the only amount of that is taxable is $2,385 of taxes, because that is 10% on the max level of $23,850.
So it's 10% of that number over 30,000 up
correct.
to the 52,000 number.
So if you take that and divide it by the $53,850, you actually have an effective tax rate of 4.91% if you have maxed out the full 10% bracket. If we get into the next bracket, which is our 12%, that takes us out to the top side of $96,950 of that bracket, which would be $23,851 up to $96,950.
Okay.
So that would give us a total income level of $126,950. If we take our applicable tax of the 10% bracket, if we maxed it out, of $23,885, plus if we max out the top side of the 12% bracket, that would be $8,772. If we add those two amounts together, divide that into the $126,950, that gives us an applicable tax rate of 8.79%. So going through the first two tax brackets, which is a 10% and a 12%, we actually have an effective tax rate of 8.79%, all because of that standard deduction, that coupon. Okay. So a lot of times we have individuals that hear on the news that the tax brackets are designed for the high net worth individual. When I'm working with clients, I find that it's the opposite. I think our tax code is really being designed for the low income and the more modest income individuals, because we actually have 7 layers of the tax bracket. So if you find yourself as a high net worth individual, we have a much higher progressive tax rate that is being applied to your earned income, which in turn makes a much higher amount that you're contributing in taxes. And I think it's very important that our listeners really make a distinction between an individual's assets and their earned income.
Okay. We
are not necessarily taxed on our assets. As we talked about in our previous show, we talked about an IRA and how the earnings inside of it is tax deferred as long as it stays inside of that IRA account or IRA annuity. That's not taxable the same way that earned income is. It is taxed in the future when the money comes out. So when we look at individuals that may have high net worth, they may own businesses, they may own accounts or annuities that where their net worth may be substantially higher than us, but it has not been converted back into earned income. So I think there needs to be a real understanding of how the progressive tax rate really works, and that is on our earned income. So yes, there are times where we may have billionaires paying less than maybe a school teacher. It's not because they're not more wealthy. It's that they're not generating more taxable income than what that other individual is generating.
Well, from our show title, the tentacles part, tell me a little bit more about that.
Sure. Well, for probably a lot of our listeners today, when they think of the makeup of their retirement income, they're going to have either, if they're fortunate, they're still going to have maybe some pension money coming in, which is under a defined benefit plan, or they may, after 1974, been moved over into a defined contribution plan, which is 401ks, 403bs, 457s. And so as they've aged, there's a point of where that money is going to be coming out of those accounts. So that's going to be earned income for that year. That's going to maybe be complemented by Social Security. And so as we're looking at this progressive tax rate, Social Security in itself is not taxable, because if you are in the 10% tax bracket, which caps out at $23,850, that is below the starting threshold of where Social Security can be subjected to taxation, and which is $25,000. So when we're looking at that, Bradford, it's, if you're in that 10% tax bracket, you're not going to be taxed. If you're making $53,850 or less, your Social Security is not going to be subjected to tax. As we look at it, as we go up higher through that tax bracket, those tentacles are going to reach out to other sources of income, such as Social Security.
Okay.
If your income goes up too high, or if you make a mistake by converting too much of your 401k, 403b, or 457, or if it's in an IRA, if you convert too much of that over into a Roth IRA, you could then subject your Social Security, and you may also subject the cost of your Medicare premium annually.
I was wondering about the Medicare part.
Yeah, that's another tentacle that it's a means-tested benefit. So the more income you're generating, the more of the government benefits that we receive that could be subjected to either higher cost or exposure to higher taxation.
For the benefit of our listeners, means testing, can you give us a real quick explanation?
When Congress comes into session and they're looking at the viability of applying tax rates to individuals. Because first of all, we have to step back and take a look at the government. How does government make money? Well, there's sources of taxation that are brought in, and then it sells treasuries, U.S. securities, to individuals, countries, other entities out there. That's the only way the federal government can generate money to operate. So one of the ways that they're constantly looking at is the adjustment of what our tax code is, which is we want to make it something that is applicable to each of the different sectors of our society, and saying what would be a fair and adequate amount for what they're making a contribution. They also look at that as you earn more, you pay more. And so that's what means testing is. If you have more means, they're going to be looking for you to make a higher contribution back, either in the premiums that you pay, such as in your Medicare premiums, or they're going to be looking at you paying more in taxes into the government.
Okay. So you've given us some of the realities. What are some of the remedies for the taxpayer? How can you avoid it?
Well, again, it goes back to what we originally stated at the beginning of the show, is you need to have a tax coach. It's not enough to have an investment plan that where maybe you're doing it yourself, or if you've hired a professional, like we've talked about on one of our previous shows, is that you've hired that individual to help you navigate the process. You also need to have a tax coach. If you're working with a certified financial planner, if you're working with a person that has maybe a family office practice or a fiduciary, somebody that is holding a capacity of working in your best interest, that individual is going to look at putting these two pieces together. The dovetailing between the investment process and your tax plan should be working in synergy together, because as we state in our office all the time, it doesn't matter how much you make. What matters is how much you get to keep. And so you can have a great investment plan, but if you don't have a complementary tax plan that has gaps in it, you could be paying unnecessary amounts of taxes each and every year that could be pulling thousands or tens of thousands of dollars out of your retirement. Because if you pay unnecessary amounts of taxes, then that money is no longer in your investment account so that you can keep compounding on it. So it gives you a triple compounding and reverse effect. So the solution is really look at an individual that is not a salesperson. Don't go out and find that individual that maybe works on your fear or your greed emotion and either sells you a product or sells you a one-dimensional solution, but really work with somebody that's looking dynamically at a multi-dimensional plan for you that can help you keep each of these areas in perspective.
So if you're looking for a tax coach, what would be a couple of pitfalls to avoid? And then what would you, and I think you just kind of touched on this, but just to really drive home, what should you be looking for?
Yeah. When you meet with your tax preparer, if you're working with a person that's working in the historian capacity today, which is really from February to April, unless you have an extension, don't come to that individual during that time period expecting them to really be able to coach you.
Busy time.
It's a extremely busy time. They're not going to be able to give you the full devotion of what they're doing, whether they're a CPA or an enrolled agent. They don't have the capacity during that time.
So to use like another sports analogy, come to them in the off season.
Come to them in the off season and have a preseason plan, an in-season plan, and a post-game review. So in that, if we're using that athletic analogy in this, is you need a plan that begins in January and that you're taking action during each of those preseason months. And then maybe if you're in the middle of a season, maybe you're doing these, and then let's come back and recap. You're doing tactical and strategy sessions up on that so you can make adjustments. You want to control your taxable events in the future. You don't want to be subjected because the government is modifying the tax plan. You take control of your taxable events. Make sure that you know and can anticipate what's going to happen versus a gotcha situation.
Okay.
Now, one of the things that is very important out of the one big beautiful bill that just came out is a $6,000 additional deduction that's going to be able to be taken by individuals over the age of 65. So make sure you're talking to your tax coach in advance of how you're going to be able to put that in play. One of the ways you could do it potentially is use that extra money to Roth a portion of your money out of your IRA into a Roth IRA. Use that additional $6,000 as a boost on that coupon we talked about earlier, and get that money moving out of a taxable account into a tax-free account.
Are there any credentials that people should be looking for when they're looking for a tax coach?
You know, a CPA is probably the gold standard in anything that you're dealing with taxes. Enrolled agents, from my review of working with advisors, the people that really focus on taxes are going to be those enrolled agents. A CPA may be a much broader, working maybe as a comptroller and things of that nature, but just really interview them and find out, what do you specialize in? And are they connected with a certified financial planner? Are they connected with an investment advisor?
An attorney.
In this industry, you're looking to work with multi-dimensional individuals where they're looking at all aspects, not just one-dimensional.
Okay. Would it be important about the size of their current caseload or their client load? Would that be a determining factor too?
Yeah, that's a great question. If you're working with somebody that has 400, 500, 600 clients, you have to really ask, well, how much time do you spend? And it becomes a mathematical equation at that time. If somebody has 600 clients and they're telling you they're going to be working with you maybe, 10, 12 hours in the year, well, simply divide those numbers. And do they have the capacity to be able to do that? Or do they have junior, credentialed individuals in their office that can also help along the way? Maybe somebody puts the overall plan together for you, but maybe they have administrative staff or junior support staff that are also credentialed that can be that person that meets with you one-on-one, maybe each month or a quarterly or whatever that time period that's required.
Okay, so it wouldn't necessarily be a reason to not use somebody. They just might have different layers to their practice.
Yeah, do a good interview. Make sure they're a good fit for you. If you follow that process, you will find more certainty in these uncertain times.
So what if somebody doesn't know where to go to find a tax coach?
Well, all of our listeners are welcome to always call our office. They can reach us at 855-378-1806. Again, 855-378-1806. We have a team of tax coaches. We have a team of certified financial planners. We work with attorneys to really holistically look at who you are, where you want to go, and give you the highest level of probability of achieving those objectives.
So this is Invested in Faith. And if you got value out of today's show, please like, subscribe, and tell your friends about us. So tune in next week when we tackle the one big, beautiful bill. That's going to be a lot. It's going
to be a great show.
It's going to be a great show.
Thank you, Bradford.
All right. Thank you.
Optivice Advisory Services, LLC, Optivice, is an investment advisory firm registered with the Securities and Exchange Commission, SEC, under the Investment Advisors Act of 1940. Registration as an investment advisor does not imply a certain level of skill or training. The oral and written communications of an advisor provide you with information about which you determine to hire or retain an advisor. For more information, visit https://advisorinfo.sec.gov and search for our firm name. This presentation has been provided for informational purposes only and is not intended as legal or investment advice or a recommendation of any particular security or strategy. The investment strategy and themes discussed herein may be unsuitable for investors depending on their specific investment objectives and financial situation. Information obtained from third-party sources is believed to be reliable, though its accuracy is not guaranteed. Opinions expressed in this commentary reflect subjective judgments of the author based on conditions at the time of publication and are subject to change without notice. Past performance is not indicative of future results.